All right, let's get right into it. Today, we're going to tackle one of the biggest, most expensive myths in trading, this idea that support and resistance levels are some kind of safe zone. We're about to find out why the trades you think are your safest often end up being the ones that blow up first.
I mean, come on, we've all been there, right? You line up what looks like the perfect trade. You set a totally logical stop loss just below a really clear support level. And then you just watch in horror as the price dives down just enough, just barely enough to take you out of the trade before it screams back in the exact direction you predicted. It feels personal. It feels like someone's out to get you. And you know what? In a way, they are.
You know the textbook definition. Support and resistance, S and R, they're the price barriers. Support is the floor where all the buyers are supposed to jump in. Resistance is the ceiling where sellers are supposed to take control. It's trading 101, the first thing we all learn. But what if that core belief isn't just flawed, but actually dangerous?
This right here, this is the whole game. It's a massive difference in how the world is seen. While we, the retail traders, see a protective wall, a safe spot to hide our stop loss, the big institutions, they see the complete opposite. To them, that level is a giant glowing magnet for liquidity. It's a hunting ground, practically screaming, all the stop-loss orders are right here.
So here's the core idea you have to get your head around. It's not that these levels are useless, it's that their very predictability becomes their biggest weakness. The fact that everybody sees the same obvious level on the chart turns it from a safe house into a giant bullseye. Price isn't moving to respect the level, it's moving to eat up all the orders that are sitting there.
So that's the million-dollar question, isn't it? Why does this happen so consistently? I can promise you it's not random. It isn't just market noise. It's a built-in feature of the market, and it's driven by cold, hard data and human psychology.
And here's the proof in the pudding. Studies have shown that the density of orders, we're talking stop losses, limit orders, the whole shebang, can jump by as much as 300% around obvious psychological levels. You know, like a big round number. Think about a price like 1.2 thousand on a currency pair. It's basically a giant flashing neon sign for smart money that says, hey, the cash is right here.
Now, this cluster of orders doesn't happen by accident. It's literally hardwired into our brains. We've got a round number bias. Our brains just love simple, clean numbers. We suffer from anchoring, where we get obsessed with the last major high or low. And of course, there's herding. When thousands of traders are all staring at the exact same chart, guess what? They tend to put their stops in the exact same places.
So all these little mental shortcuts, they combine to create something incredibly valuable for the big players. A visible, predictable, beautiful pool of liquidity. If you're a massive fund that needs to fill a huge order, this cluster of retail stops is the perfect opportunity. It lets you get in or out of the market at a great price without tipping your hand too much.
And this just lays bare the massive information gap we're up against. We see a pattern on a chart. They see the actual order book. They know exactly where those pools of money are. We react in a few seconds by clicking a mouse. Their algorithms execute trades in microseconds. And maybe most importantly, they have enough capital to literally push the price to those zones whenever they want to.
So how does this whole thing play out in real time? Well, it's a pretty clear sequence called a stop hunt. First, you have the accumulation, where price just kind of drifts towards that obvious level. Then you get the ignition. A big order shoves the price just past the line. This triggers the first few stops, which creates a cascade, like dominoes falling. This flood of selling or buying is then harvested by the institutions to fill their orders. And then what happens? Once all the stops are gone, there's no reason for the price to be there anymore, and it snaps right back.
And don't think for a second this is some rare event. The data is pretty staggering. Somewhere between 70 and 80% of what initially look like breakouts of these key levels are actually fakeouts that reverse almost immediately. Most breakouts fail because, well, they were never real breakouts to begin with. They were liquidity hunts, plain and simple.
Let's just look at the simple math here, like it's a game. If an institution just respects the level and plays nice, what do they get? A big fat zero. But if they hunt the stops clustered just beyond it, look at that, a massive payoff. It's not that they're evil or malicious, it's just that hunting the stops is by far the dominant and most profitable strategy available to them.
Okay, so that's the problem. It sounds a little bleak, I know, but understanding the game is the very first step to changing how you play it. So how do we stop being the liquidity for these big moves and actually start trading alongside the hunters?
The answer requires a total shift in your mindset. Rule number 1,
Expect the level to fail. Make that your default assumption. Rule number 2, never trade at the level. You wait and you trade the reaction after the violation has already happened. And rule number 3, you have to wait for confirmation. A big long wick on a candle and a strong close back inside the range, that's your signal. That's the all clear that the hunt is over.
This also completely changes how you set your stop loss. The trap, the vulnerable spot, is right there at that obvious level with everyone else. A smarter, more robust stop is placed well beyond where that hunt is likely to end, maybe 15, 20, 30 pips past the obvious line. You're trying to hide it in a technical dead zone, an area with no obvious reason for price to go there. You give the trade room to survive the shakeout.
And if you need proof that this approach works, the numbers don't lie. The difference in performance is just night and day. Trying to trade a classic breakout or a simple bounce gives you a win rate in the low 30s. It's basically a coin flip. But waiting to trade the reversal after the stop hunt is finished, the win rate nearly doubles to over 60%. That's because you're finally trading with the big money flow, not against it.
So let's end on this. This is the ultimate takeaway. The goal of technical analysis isn't to be a psychic and predict where the price should go. The real goal is to understand where the money, the liquidity, is piling up, and then anticipate how the biggest players are going to move in to grab it. Support and resistance levels don't mark barriers, they mark the battlefield. The only question is, which side are you on?